Welcome back to Market on Close. Let's try and dig through the action, find the signals in the noise, which is exactly what Mr. John Kosar tries to do with us every time he's here on the show. He's the Chief Market Strategist at Asbury Research. And John, you've done a scary good job of that here this year because we've spoken a few times. One, you were turning a little bit cautious based on your models near the highs, even before the virus stuff really started taking off, and then getting pretty bullish based on your models near the lows. So, I mean, just hit me. What do we got now? What does it tell you now?
Our models have been risk on since we have two different tactical models. One is CPM, or the correction protection model, and the other one is the Asbury 6. One of them went risk on April the 6th, one on April the 9th, and there was a weekend in between those 2 days, so pretty close. And they are still on a risk on, but we're sitting in front of some pretty important, we're sitting right on top of a really important level. And what we call it is the Asbury 6 is starting to blink a little bit. You're starting to see over the past week, there's a couple that'll turn red and then they'll turn back to green and back to red again. So that tells me that this is an inflection point. This is a fulcrum in price, so to speak, where the market is at a trampoline point, let's call it, where we either have to re-engage the current uptrend soon, days, or we're going to go into some kind of a move down. We don't know how deep or how far, but we know that it should be something tactical, several weeks or more.
So, John, a turning point potential. I do see there's some negatives in your Asbury 6 market metrics. The performance versus high yield, investor asset flows, and trading volume. Those sound like things that tick up when there's too much froth, not necessarily fundamental deterioration. Am I right?
That's absolutely right. A metaphor for this is the 6 cylinders of a car. It's kind of an under the hood look at the market, I think. So asset flows, we're looking at money flowing into the market. That's what makes prices go up. Corporate bond spreads are an indication of risk from the bond market. Trading volume shows urgency. Market breadth shows participation. The only one of the 6 is up top. That's the rate of change in the S&P 500. And we did that for a reason. With all of the algo trading going on, the high volatility, you walk into the market one day, it's up 30, the next day it's down 40. So I don't look at price as, with the blinders on like I did earlier in my career. I want to see what's going on under the hood, and these various metrics act as kind of a lie detector for that.
Okay, gotcha. And if we could just actually flip back to the last table just to see, because there's two parts here. One is the Asbury 6, those internal market metrics, where the rate of change has still been positive. Obviously, it's been pretty impressive here. The other, John, is the tactical versus strategic look. Here's the one that you were just talking about, the internal metrics. So they're pretty much divided right now. So what will you be looking for, John, to see if the division breaks in the way of even more bullishness? How does that register when the froth is already high? Do you have to have a reset before your internal metrics can turn more positive, or can they accelerate in their degree of positivity?
That's a great question. The answer is yes, they're in balance right now. They're actually 2 are red right now and 4 are green. But that just shows you we're in balance and we're in a spot where we're likely to make the next directional move. And this would be tactical. This would be several weeks. So this is not actionable until there's 4 going one way. So right now it's 3 and 3, but it's still actually holding the risk on signal, which was 4 or more green, that dated back to April the 6th.
Okay.
So 4 of these would have to turn red, and that would give us an indication that the market is weakening internally, and we would be taking risk out of the market at that point.
Gotcha. Okay. Let's talk about some of the specifics here, because we've had this division between the NASDAQ and the Russell. You're looking at these metrics according to the S&P 500. What if you go to the small caps? How do they look?
The small caps, we actually put a chart up on that on Monday. The small caps have been underperforming. I'm looking at the Russell RUT, and the rally off of the mid-March lows, it got through the 200-day moving average for a little bit of time at the early part of June. And then we've since backed off. There's some other resistance there around 1460. We fell through that as well. So that's the level that I would be looking for. Again, if we stay risk on, if 4 of the Asbury 6 stay green, and the Russell could get back up above the 200-day, which is at 1480, hold it, then I might be looking at some relative performance charts, seeing how it's performing relative to the S&P 500, and at that point we may put some money to work there. But as long as it's underperforming, you know, the place to be obviously since the bottom has been technology, and that's been the fastest horse. So even though, you know, the Russell would be one that I would not allocate any capital to until one, I saw the S&P 500 be able to hold this 3100 area that it's been testing, and then secondly, 1480 would have to be taken out on the Russell. And then at that point, again, I would look at the relative performance charts and see if there's something there that could give me more alpha.
So you want to see the S&Ps hold and you want to see the Russells hold before you get more convinced about the small caps, the chart we're looking at right now, which is basically where we are. It seems like your technical work is in line with what I've been describing from the market narrative perspective here, John, that there's a lot at stake right now. There are some charts that are starting to move a little bit more range bound, but to me that doesn't really resonate with how much is going on in the economy and all the everything that's at stake right now. Is that what you're seeing, that there could be a big move ahead?
You know, the last guy that was on, I was just watching your show, and the guy with the cow jacket.
Yeah, Scott.
Yeah, he's been around a while like I have,
Yep.
and I really like what he said. He's, you know, I think when you're early in your career, you want to be the predictor of markets. You want to be the guy that can call the market. You don't make I don't think you make a lot of money trying to be Houdini. You make a lot of money trying to figure out what he called it what people are thinking. We're totally data-driven here, so we're reading data. All we want to do is find a wave and jump on that wave and know where the inflection points are. So right now, we know we're at an inflection point. The wave has been up. We've been back in the market since the early part of April. But if we can't hold in here, and again, I look at the S&P 500, you know, the support in the S&P 500, I said 3,100. It's actually about 3,000 to 2,950. If either of my tactical models, our tactical models at Asbury Research, flip to a risk-off signal and or SPX can't hold 3,000, we're aggressively pulling money out of the market. My thoughts are, this is overdone. You know, there's talk about another wave of COVID coming. There's a lot of turmoil in politics. We've already had a heck of a rally off of the March lows. So, you know, my gut's telling me, and sentiment indicators are, everyone's too bullish here. Put-call ratios are very low. But that's not going to make me pull the trigger. What's going to make me pull the trigger is understanding where we are in the trend, understanding where the key levels are, and watching the internals to tell me if it's time to take risk out of the market.
John, the last time that I remember you sounding fairly bearish, I believe, correct me if I'm wrong, was either in late Jan, maybe early to mid-February. I know that you look at put-call ratio as one signal of froth. You also look at a futures trader sentiment. You highlight that those were last elevated in that early 2020 period. What was the most compelling signal that you saw to get out of the market or wax more bearishly earlier in the year?
It's a good question. I get it asked all the time, and I think most analysts do as well, is what's your favorite indicator, or what indicator do you put the most trust in? The reason we built these models, and I hate to keep going back to those, but you know, the reason the Asbury 6 is not the Asbury 2 is because no one or two indicators work all the time. And once you start thinking that you found the indicator, I think you set yourself up for a lot of trouble. So it's more the collective message of everything. Again, we started seeing sentiment getting frothy in January. I think the put-call ratios were starting to get very low, but we didn't get the actual signal to pull money out of the market until the end of February. We were about 1.5% to 2% off the highs at that point. I'm not interested in trying to pick the highs or pick the lows. You know, that's for the guy telling everyone how smart he is at the holiday party. I just want to catch the 70% in the middle, and that means avoiding a lot of the chop that you get at the extremes. So there is no one methodology. I mean, we look at sentiment like an indication of, you're at the ball game. It's the 8th inning. You could go into extra innings and play 10 or 11 innings, but you're getting close to the end of the game. That's where we were in January. And then when the models turned, that was when it was time to get out of your seat and get to the car before everybody else does.
John, really like the thoughts here. I think it makes sense, especially for a lot of folks who are watching, not just the professional investors, but those who manage their own money or do it on their own for short-term trading. That point about not trying to get on the peak is one that can still be very rewarding even if you miss it, and you kind of want to. You want to hit the wave as it's rolling. So right now, over the next couple weeks here, just real quickly before we let you go, is there anything that we're missing here? Is there anything that stands out to you as the highest risk point for that reversal in trend, or the most bullish thing right now that looks like it could break?
There's no one indicator, but when we're going back to looking at the levels in the S&P 500, 3,200 is a really important level up top. I think if our Asbury 6, again, which have been blinking, from 6 green to 4 green and 2 red, and then 3 and 3 like you saw from Monday, everything turns back to green. I'd like to wait to see if we can get through that 3,200 level in the S&P 500. That's the lows from the very end of January. If we could get through there and tech, the stocks, stay up above their previous highs that we made back in Jan and Feb, I think the S&P could then take a run at the old high, which was 33.94, looking at my chart from February the 19th. Here, again, if you're a trader, if you're somebody that's looking, I try to figure out what the analysis is, and then I try to see what the risk reward is there. And that's the part that sometimes people leave out. Even if you get the analysis right, if your risk reward is backward, you're going to lose money on a good idea. So the level to lean on if you're looking to put some new money to work would be that 3,000 to 2950 area. And looking across the room, we're at 3139 in the S&P. So you've got about 100 to 150 points of risk in here. Yeah. I think that's what you have to risk to put some new longs to work.
John Kosar, pleasure for to have you here. Pleasure to hear the walkthrough. Thanks a lot for joining us on Market on Close. As always, John joining us from Asbury Research.